Monday next class same 11 o'clock. Okay. Hello, Mr. Sheikh. My voice is audible? Hello.
Yes, sir.
Yes, ma. It is very clear, right? My voice is clear, right?
Yes, sir.
Okay. Today we are going to discuss one of the topic in block number 2. It is a very important topic that is called ratio analysis. So what we can do is, in our syllabus, we are going to discuss the meaning, definition of ratio analysis. What are the objectives of ratio analysis, and what are the different types of ratios, or it is called as classification of ratios. And the ratios are classified into various types. Nothing but some of these profitability ratios, liquidity ratios, activity ratios, and solvency ratios. At the end of this session, we are going to understand what are the advantages of ratio analysis and limitations of ratio analysis. So this is the total agenda of today's presentation. Let's start with what is the meaning of ratio analysis. So it is a continuation of previous session. In the previous class, we discussed three tools of financial management, three methods of management accounting. One is comparative statements, common statement, and trend analysis. Now we are in fourth topic. It is ratio analysis. So based on this data, based on this income statements and balance sheet, we are going to prepare ratio analysis. So why ratios are very important, right? Like earlier also we know that the various people are very interested to know that company performance, right? Like various stakeholders, investors, creditors, government, and analyst persons, and stockbrokers, SEBI, like various people are very much interested to know the company performance. So like how to know the company performance, like one of the tool is ratio analysis. It's a very powerful analytical tool to use for measuring the company performance as an organization using the accounting ratios. Like, blood pressure, how we can solve blood pressure, know that just we can take a sample, blood pressure, pulse rates, okay, body temperature, like, how we can just diagnose the total body temperature, right? And to test one blood test, see that what is the blood count, all this. So like, you can apply this ratio analysis, 2 or 3 ratios enough to judge the company performance, or to know the company is performing well or not, company operation performance well or not. So like, just 2 or 3 ratios are enough to judge the company performance. We will compare one company performance to other company, or one company to industry performance. Okay, and also these ratios can be useful for comparing this year result to previous result or last 5 years result. So like, it's very much useful for taking a decision making of a managers, right? So what is the meaning? See that the accounting ratio is a very simple and tool. A ratio is a mathematical number calculated as a reference to relationship between two or more numbers that can be expressed in a fraction, proportional, percentage, or number of times. Right? So ratio is a relationship between two numerical numbers. Okay, sometimes two or more numbers. So that relationship can be, we are expressing in different ways, sometimes fraction, sometimes proportion, sometimes is a percentage, sometimes what we call as a number of times, right? So like, we will take a 2 years data, two accounting period data, sometime one accounting period data, we will use for analyzing this ratio relationship. Okay, and so what are the objectives? Why we need to study the company these ratio analysis? Okay, the ratio analysis is interdisciplinary part of interpretation of result of the companies, right? And it's a very important technique. So the objective is everyone wants to know that the area of business which need to more attention. So management want to know that where they want to increase more attention, or they want to go good profits. Okay, something like it is give some kind of direction, and also to know about the potential areas which can be improved to affect on this desired direction. So they want to increase the company profits, or they want to start a new venture, or they want to increase this volume, or they want to increase their production capacity, right? And see that what is the impact for EPS, earning per share, okay, or net shareholders wealth, and also to provide a deeper analysis for company profitabilities, liquidity ratios, solvency ratios, and efficiency level of the business, right? So this is a deeper analysis to know the company profitabilities, right? The sales, sometimes sales are increased, but profit may not be increased due to various reasons. Okay, at the same time, the liquidity position. Sometimes the liquidity position is good. So see that all liquidity, all asset cannot be converted in cash within a span of very quick, right? And we know that debt equity ratios, solvency ratios, and also to provide information for making the cross-sectional analysis by comparing the performance in best industrial standards. So these ratios are very much useful to compare our company performance to, so one company performance to other company performance, means competitive company performance. Or else we can compare one company to the standard, the leader. See that we can analyzing, for example, we can take a comparison between the banks. So one private bank can compare its performance with SBI, is a leading bank in the PSU sector. Or we can compare with ICICI Bank, is a leader in private sector. So like, we can compare using these ratios, and to provide information for making cross-section industries, to provide information derived the financial, making the predictions and estimate the company futures. So as earlier in this 4 classes we have discussed, the management accounting is give this information for managers to take the company decisions for future growth. Okay. And what are the different types of ratios? The ratios can be classified in different ways. Traditional classification as well as functional classification. So this is sometimes we classified the ratios are based on the statement. So based on the income statement, or it is called as a profit and loss ratios. Okay. So here we'll calculate only the ratios on the gross profit ratio, net profit ratio, operating profit ratio, or expenses which we calculated. Mean all the data related to only profit and loss account. The second one is balance sheet ratios. So balance sheet ratio means based on the balance sheet data. So we can calculate the current assets or current liabilities, or you know that using for the company debt, what is the proportion of this asset turnover ratios, all these. So composite means we'll take some data both in profit and loss account, sometimes it's a balance sheet. So both data we can use for comparison. See that sometime, for example, the ratio of credit revenue from operations trade receivables. So trade receivables and trade sales we can use for these purposes. Okay. And on the whole, as per our syllabus also, see that the ratios are classified into four: profitability ratios, liquidity ratios. Third one is activity or turnover ratios, solvency ratios. So these are classified as per our syllabus. So first we'll go for first ratios is called as profitability ratios. Every firm want to know the company profitability. Right? It measures the profit is one of the tool or yardstick to measure the company performance. One of the measurement, right? Is the profit is one of the measurement to know the company performance. If the company profits are good, say that the company performance is efficient, right? And the employee performance is also good. So these ratios indicate the success or failure depending upon a business enterprise in a particular period. Naturally, it is a 1 year or sometime if it is a listed stock market, it is a quarterly income statement. So profitable ratios are useful for helpful for all the parties, all the stakeholders connected with the business, including the government. And a strong profitable position ensures the common stock shareholders, nothing but the equity shareholders. So they want high income dividend, or they want to appreciate their value in stock market in future. And the creditor also. So if the creditor wants to say that the company has to prompt the payment of interest as well as the principal amount, and it's a fixed dividend for preferred shareholders. So like the management need for high profits and to pay the dividends or reinvest means the retained earnings, flagging of profits. So whatever the profits are received the company, again the company has the two alternatives. Either they can go for distribution of the profits through the dividend, or they are retained. So which decision are influencing the market price of the share? Nothing but what we call wealth maximization. Wealth maximization of the equity shareholders. So what is this? See that increase in production capacity and overall financial position of the company. So as per some of the important ratios are in profit and loss accounts are net profit ratio, gross profit ratio, price earning ratio, operating ratio. We'll go for one by one. The first one is net profit ratio. It's a very popular profitability ratios that shows relationship between net profit after tax to sales. Right? Net profit to sales. Net profit after tax. So we'll say that after tax, not the before tax, after tax. Okay. Nothing but it is a PAT, profit after tax. And see that these ratios are equal to gross profit ratio minus operating profit. So we know the net profit. And the second one is net profit ratio are very useful to measure this. The overall profitability of the business. Overall profitability of the business. A high ratio indicates the company efficient performance affair to the business. So how we can take a decision if it is high ratio, see that the company performance good. If it is low, the company performance may not up to the mark. So the company has to change their policies, or company change their price strategies, or they want to go for going for different kind of strategies for growing this company profits. The second one is gross profit ratio. So this is also profitability ratio to know that the relationship between gross profit to net sales revenue. Okay, how we can calculate this gross profit? Very simple. And sales minus cost of goods sold will calculate this cost of profit, gross profit. Sales minus sales minus cost of goods sold. Okay, so we know that gross profits. Okay, so we want to know that cost of goods sold sometime. So what we can do is sales minus gross profit is also called as cost of goods sold. Okay, cost of goods sold. So when you are calculating this gross profit ratio, so very simple. First, you need to calculate gross profit. How are you going to calculate gross profit? Sales minus cost of goods sold. You can calculate in the gross profit. Sometimes the examiner is you want to calculate some other ratios. You want gross profit, cost of goods sold. What you can do is sales minus gross profits. Okay. Any doubt here? Any hello? Any doubts?
No, sir.
Okay. So here gross profit ratio, sometimes gross profit margin ratio, say that the margin ratio in terms of percentage. Okay, in terms of percentage. So when you calculate the profitable ratios, the denominator is always net sales. So what is by net sales? What is meant by net sales? Total sales minus sales returns. Okay, it is called net sales. Okay, total sales minus sales returns. Total net sales includes both cash sales spread, credit sales. Am I clear? So what is the net sales? Net sales minus total sales minus credit sales. Okay, credit sales. Net sales is equal to cash sales plus credit sales. Okay. Right. So here PE ratio is a very important ratio. This is later for the profit earning ratio. And see the third ratio is operating ratio. Okay, operating ratio means the company want to know that what is my operating cost. So total sales, what is my operating ratio? For example, the sales are 100 rupees. What is the cost? The cost is 80 rupees, 80%, or it is 90%, or it is 100%. Right? So the cost is always lesser is preferable, profit always is higher is preferable. Okay. See that the basic component of formula is operating cost and net sales. So we are going to judge the relationship between operating cost and net sales. So what is operating cost? Operating cost is equal to cost of goods sold plus operating expenses. Operating expenses. So what is cost of goods sold? How we are going to calculate the cost of goods sold? Earlier I told you how to calculate now. How we can know that cost of goods sold? How we calculate the cost of goods sold? Cost of goods sold is equal to what is the formula? What is the formula? Net sales minus GP. What is GP? What is GP? What is meant by GP? What is GP? Gross profit. Okay. So cost of goods sold we calculating using this sales minus gross profit plus operating expenses. So what are the operating expenses? The operating expenses, employee salaries, printing and stationery, other expenditures, all other indirect expenses. Operating expenses. We are not adding any non-operating. Non-operating expenses nothing but interest charges, taxes, interest on debentures. Okay, like are excluded from this calculations. So this ratio is measure operational efficiency of the firm. Right? Is the firm is any controlling the cost or not? Operational efficiency of the management. Means if you can produce, the company want to produce the product at a lower rate, not the higher rate. They want to control the cost. This ratio indicates the company operating efficiency. Are they really focusing on the cost control or not? Okay. And this ratio should be compared with the company past ratios and also the other company ratios, same industry. Okay, an increase in the ratio should be investigated, brought to attention management. So if the cost, for example, see that we have 2 years data, it is 2021 data and 22 data. right? So here operating cost ratio, earlier it is 85%, now it is 90%. What it means is it is a good or bad to the firm. If the company is operational performance good or bad. So previous it is 85%, now it is 90%. Anyone respond, please? Is it good or bad? Earlier, previous year, the operating ratio is 85%, right? And now it is 90%. So what it indicates, how we are going to interpret the company may not perform well, right? See, earlier, the remaining percentage, okay, the remaining percentage of 50 rupees profit, 50% profit here. Now this year, the 10% only profits. Okay, 90% profit. Now the company has said that some questions, why this happened? Okay, where is the problem? Why our operating profit are not increased, operating cost increased? What are the reasons? Okay, and like the company takes some decisions. And sometimes we calculate individual ratios, expense ratios, salaries to net sales, or advertisement to net sales, some other expenses, right? Selling expenses. Administrative expenses to sales ratios, sales expense to sales ratios, like we calculate individuals. So return on shareholders, we'll also discuss later part in third EPS ratios. Now see that ROC, now we'll go for payment. So this is one problem for how we are going to calculate. Okay, this is the data of March 31st, 2016. So we have this trading and profit and loss accounts, opening stock, purchases, wages and gross profits, sales and closing stock in credit sides, and debit side of expenses, administrative expenses, selling and distribution expenses, non-operating expenses. The final one is net profits, gross profits, interest on investments, profit and sale of assets. So what these are operating profit, non-operating incomes. So calculate ratios. So we will calculate these. So in examination point of view also, we are expecting this kind of problem. Okay. So we need to calculate these ratios. So once you can understand this formula, very easy to calculate. Okay. First, we can understand the formula. So always when you're calculating these gross profit ratios, so denominator is sales. The only thing is you want to calculate gross profit ratio, go for these gross profits. What's the gross profit here? What's the gross profit? 2,01,000 divided by, what's the sales? 5,60,000 into 100. Very simple. Into 100. Right? So your gross profit ratio is over. So now you want to calculate net profit ratio, right? You want to calculate net profit ratio. So what is the formula for net profit ratio? Anyone? 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 What is the net profit ratio? How to calculate, man? How to calculate net profit ratio? Please respond. Hello? Venugopal? Venugopal? Hello? Uthar Sheikh, are you there? Hello? 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 Okay. So the net profit ratio is net sales by net profit by sales into 100. Okay. So here the formula is net profit by sales into 100. So here the gross profit rate is 35%. The net profit rate is 14.3%. Okay. So here you can see that operating ratio. So cost of goods sold plus operating expenses. Cost of goods sold plus operating expenses. So what are the operating cost of goods? How we are going to calculate? opening stock plus purchases plus wages. So all the items in this trading account debit side minus closing stock. Closing stock, okay. Or else, how we are going to calculate? Very simple. Sales minus gross profits. Okay, we know that cost of goods sold. Sales minus gross profit is also called as cost of goods sold. You can also use this kind of formula also in a simple manner. Okay. Then is operating expenses ratio. What are the operating expenses? Operating expenses are items in the goods. So in given problem, operating expenses are administrative expenses and selling and distribution expenses. Okay. Operating expenses are these two. Okay. Okay. It's like we are going to calculate these two ratios. Okay. Wait a minute. I need to clear this chart. So what is operating ratio? Operating ratio is nothing but when you calculate operating ratio, we'll take two or cost of goods sold plus operating expenses. Okay. So now what is operating ratio? Is 3,59,000 is a cost of goods sold. This one. Okay. 3,59,000 is a gross cost of goods sold plus operating expenses are 1,09,000. The total expenses divided by net sales into 100, 83.6%. Means if the sales are 100%, out of 100%, for example, the selling price is 100, out of 100 rupees, the cost of production is, cost of the product is 83.6%. Okay, 83.6%. Now the difference amount, whatever the difference amount is there, that operating profit ratio is 16.4%. The purely 16.4% is operating profit ratio. 16.4% is a purely operating ratio. So can you go for this gross profit ratio? Gross profit is 14.3%, but operating profit is 16.4%. Okay. And this in the gross profit, when you calculate this net profit ratio, you included both non-operating profits and non-operating profit as well as non-operating expense also you included. But when you're calculating this operating ratio, you considered only the operating expenses, operating profits. Am I clear? The last one is administrative expenses ratio. So whatever the administrative expense ratio means, administrative expenses divided by net sales into 100. Okay, administrative expenses divided by net sales into 100. So this you can use the formula. So 20,000 is a administrative expenses divided by 5,60,000 as a net sales into 100, 3.6%. So what it means, the total 100%, out of total expenses are 83.6%, out of which one item included, administrative expenses 3.6%. Suppose if you want to calculate this item, what is called selling and distribution expenses ratio, what we can do is, okay, for example, selling and distribution expense ratio. So what we can do, what we can calculate here is 89,000. So this is the item. 89,000 is a selling and distribution expenses divided by net sales. The sales are 5,60,000. 5,60,000 and into 100. Then you know this selling and distribution expenses ratio. Okay. So like we are going to calculate n number of expense ratios as per the management required. Okay. Any doubts? Any doubt here? Hello? Any doubts?
Sir, good afternoon, sir.
Hello?
Sir, good afternoon.
Yeah, good afternoon, sir.
Sir,
Yeah.
just now I have joined the class, sir. You are teaching ratio analysis, sir.
Yes, I'm teaching ratio analysis part, that too in profitability ratios.
Yes, sir. I have joined 5 minutes ago, sir. Sorry for delay.
Okay. Right. So these, we are expecting the problem in examination also, these profitable ratios, right? So very simple to calculate gross profit ratio. What is the formula for gross profit ratio? Gross profit by sales into 100. And when you calculate net profit ratio, net profit by sales into 100. Operating ratio, cost of goods sold plus operating expenses by sales into 100. Operating profit ratio, operating ratio minus 100 will get this operating profit ratio. Administrative expenses ratio is equal to administrative expenses by net sales into 100. So denominator is same. What is the denominator here when you calculate all this? What is the denominator? The denominator
Net
is
sales.
always net sales. Net sales is the denominator for all these. Okay, it is very simple calculation. Okay, very simple. What is the gross profit ratio? Gross profit by sales, net profit by sales, operating expenses. Operating ratio is equal to cost of goods sold plus operating expenses divided by net sales. Okay, operating profit ratio is equal to 100 minus operating ratio. Very simple. This ratio is very simple. 100 minus operating ratio. Operating ratio will get this operating profit ratio. Administrative expense divided by net sales into 100. Okay, very simple, and you will get a good marks. Okay. So then after these operating ratios, now we'll move to liquidity ratios, or it is called as a short-term solvency ratios. Okay, so it measures the company's liquidity position. Liquidity ratios measure the company's liquidity position. It measures adequacy of current asset and liquid assets to help the evaluation of the company, evaluate the ability to pay the short-term debts. Okay. So each company is having sufficient working capital to meet all kind of expenses less than 1 year. See that this ability of a business to pay its short-term debts in frequently referred to a short-term solvency position or liquid position of the firm. Liquidity position, this short-term liquidity position. So generally the firm, see that what are the current assets? Anyone? What are the current assets? What are the current liabilities? In the balance sheets, the current assets are cash in hand, cash at bank, right? Bills, receivables, sundry debtors, closing stock, right? Prepaid expenses, all are current assets. Current liabilities are outstanding expenses, sundry creditors, bills payable, short-term loans, all are under current liabilities. Now here we will compare current asset to current liabilities. The first ratio under liquidity ratio is called as a current ratio. It is also known as, it is also called as working capital ratio. So in this ratio, we will compare current asset to current liabilities. Why? What is the need for this compared to? What is the proportion of current asset to compare to current liabilities? To meet it the short-term solvency. So what is meant by solvency? What is meant by solvency? Solvency refers to nothing but the paying capacity of the firm. Okay. What is solvency? Solvency is nothing but paying capacity of the firm. So what is the paying? The short-term payings. Okay. Short-term paying of the capacity of the firm. So this ratio gives this each firm is able to pay its short-term debt or not, or short-term obligation or not. Okay. So see that the current ratio is computed by dividing total current assets by total current liabilities of the business. So this formula we can use it. So what is the formula for current ratio? What is the formula for current ratio?
Current assets divided by current liabilities.
Current assets divided by current liabilities. Okay. So here, so first, what are the current assets? Already I explained you. The current assets are cash, marketable securities, or short-term investments, account receivables, nothing but your sundry, account receivables, nothing but bills, receivables, sundry debtors, inventories, shop, prepaid expenses, right? And here, accounts payable, sundry creditors, accrual payable, bonds payable, like, right? The second ratio is, after this current ratio, the second ratio is quick ratio, right? So in current asset, all assets are not possible to convert into liquid very without losing any value. It is very difficult. So what we can do is, out of the current asset, some items we are not considered to calculating this quick ratio. So quick ratio is also called as asset but quick ratio is called asset test ratio or calculate liquid ratio. Instead of asking quick ratio, you say that calculate acid test ratio. Okay. So here it measures the relationship between liquid asset to current liabilities. So what are the liquid assets? Okay, liquid assets are equal to total current assets minus inventories and prepaid expenses. These two. Okay. So what are the liquid assets? Current assets minus inventory, okay, plus prepaid expenses. These are we are deducting the remaining amount, the remaining one called as liquid assets. So inventory means what? It is not possible to inventory to convert it to cash within span of very limited time. Prepaid expense, already expenses are paid. We can't recover these expenses because the reason these two are deducted when you calculating this quick ratio. Okay. So what is the liquid ratio? Liquid assets? Please respond.
Current assets minus inventories plus prepaid expenses.
Yes, these two are deducted, right? When you're calculating this quick ratio, these two are deducted and there is no change in the current liabilities. Okay, the formula is like here, the formula quick ratio is equal to liquid assets minus, so liquid assets by current liabilities. There is no change in the denominator in when you calculate the current asset, current ratio and quick ratio. Okay, the only change is earlier we taken as the total current assets. So now we'll take only liquid assets. Okay. Quick ratio is considered the more reliable test to short-term solvency than the current ratio. So here some of the what we call standards are given here. So the current ratio always it is 2:1. Desirable level is 2:1. What it means? The 2 rupees are current assets, 1 rupee is current liability. 2:1 means the current assets are double to compare the current liabilities. If it is more than, for example, if it is 3:1, it is not good. If it is 1:1, it is also not suggestible. So the optimum level, the standard is 2:1 is, most of the cases 2:1 is acceptable. Like if you invest more amount in current assets, the current assets are helping assets. Okay, they are generating revenue, but to compare the fixed assets, their contribution is very less. It depends upon the business. It depends upon the operations of the business. We can't compare one business to another business. Okay, so if you dump in more in current assets, so the possibility of generate revenue is very limited to compare these fixed assets. Okay. So this is the case. So what is the standard for this optimum level of this current ratio? 2 is to ఎంత ఉండాలండి assets?
2:1, sir.
2 is to 1. Okay. Now you can compare this quick ratio. Okay, quick ratio is 1 is to 1. 1 is to 1. One is liquid assets, one is current liabilities. Okay. And quick ratio considered for more reliable to compare these current ratios. So because it shows the ability to business to pay short-term debt immediately, you can easily convert it. Inventories and prepaid expenses are excluded from the current asset for the purpose of calculation of this quick ratios. Third ratio is absolute liquid ratio. Absolute liquid ratio. Here we will consider only cash-based. Absolute liquid ratio computed divided only in liquid assets, liquidity assets, absolute liquid asset by current liabilities. So no change in current liabilities. The only is instead of taking this liquid asset, now we'll take only absolute liquid assets. Now my question is, what are the absolute liquid assets? Okay, what are the absolute liquid assets? You see that the only cash. Okay, the absolute liquid assets are equal to liquid assets minus accounts receivables. So or else the absolute liquid assets are called as cash, bank balance, and marketable securities. Ready hands in the ready to have anytime you can pay this, right? Cash, bank, and marketable securities. So market security you can sell anytime. In any time means nothing but is a working days. You can easily convert into cash these marketable securities, right? So this ratio is the standard is 0.5 is to 1. 0.5 is to 1, right? So current ratio, what is the standard? What is the benchmark? Current ratio is 2 is to 1. And liquid ratio or quick ratio
1:1.
is 1 is to 1, or absolute liquid ratio is equal to 0.5 is to 1. So 1 is common for all three ratios, right? Only change in current assets. So when you're calculating current ratio, we'll consider as the total current assets. So when you're calculating the liquid ratio, we'll consider only excluding this inventory and prepaid expenses. But when you're calculating the absolute liquid ratio, we'll consider only the cash and cash equivalents. Okay, cash, bank balance, and marketable securities. Any doubts? Hello?
No, sir.
Okay. So it is also very simple, very simple. Just you can calculate the, in a given problem, the current assets are there, current liabilities are there. Just you can compare, you'll get the answer. Okay. And see that in current asset, first we are you can remove two items, that is inventory and prepaid expenses. You will get this absolute, you will get these quick assets. So out of quick asset, you can reduce this sundry debtors, then you can get this absolute liquid assets. So three ratios are very simple to calculate. Now there is no change in the denominator. So let us see, this is a balance sheet. Right? What are the current assets? Anyone please say? What are the current assets, current liabilities in this given problem? What are the current assets, ma'am? What are the current assets here? This is the balance sheet, liabilities and assets. I'm asking what are the current assets? Sundry debtors is a current assets. Bank balance is a current asset. Short investment is current assets. And the prepaid expense is a current assets. Okay. So examination of what you can do is you can write down here CA. So these are the current assets. Okay. So what are the current liabilities here? The current liabilities are here, CL, current liabilities. Bills payable, sundry creditors, bank OD, and outstanding expenses. Now you can calculate one simple ratio, this total by this total. One ratio is over. Okay, what is the ratio? CA by CL, current asset by current liabilities. One ratio is over. Okay, let us see this problem. First, identify what are these current assets, current liabilities. So calculate current ratio, absolute current ratio, and asset test ratio, absolute current ratio, and comment on this. So here the current assets are same. I already told you 70,000, 45,000, 20,000. Total current assets are 2,65,000. The current liabilities are 1,65,000. So what is the ratio here? What's the ratio here? Current asset to current liabilities. How much? 1 point. How much? 1.61:1. It is higher the standard or less than the standard? Hello? It is a less than standard, higher the standard? Hello?
Less than the standard.
Less than the standard. What is the standard here? 2:1.
2:1.
But here the current assets are less than 2. Okay. Means the company is facing a problem for liquidity problem. Okay. Then we move to second ratio, asset test ratio. Asset test ratio is, you can see that the current asset minus stock less prepaid expenses, 2,30,000 due to current asset. The ratio is 1.31. Now, what is your answer here? 1.31:39:1, right? What is the standard here in asset test ratio? What is the standard? What is the standard? It is 1:1, right? 1:1. But it is higher. Okay. Hello, are you getting my point? Hello.
Yes, sir.
It is higher than this 1:1, right? Now the third ratio is absolute liquid ratio. They will consider only absolute liquid assets. There are only two absolute liquid assets are there in a given problem. What are the absolute liquid assets here? Bank balance and investments. So what is the bank balance here? Bank balance 45,000 and investments are 25,000. That what are the investment here? Short-term investment is 25,000. So when you're calculating this absolute liquid ratio, you will consider only the short-term investment, not for long-term investments. Okay. So short-term investment 25,000, the bank balance 45,000. The total is 70,000 here. 70,000. The divided by 1,65,000. Now the answer is 0.42. Now what is the standard here? What is standard? 0.5:1. So like here you can, there are different kind of interpretations required here. So first ratio is less than the standard, accepted standard. Okay. The second one is higher. The third one is less. Okay. Are you getting my points? Okay. Can you read the paragraph? Anyone, please? My paragraph chadavandi sorry. Hello. Please read the paragraph, ma'am. Hello.
Current ratio of the company is not satisfactory because the ratio 1.61 is below the generally accepted standard of 2:1. Acid test ratio, on the other hand, is more than the normal standard of 1:1. Liquid assets are quite sufficient to provide a cover to the current liabilities. The absolute liquid ratio is 0.42, which is slightly less than the accepted standard of 0.5.
Right. Out of three ratios are less than the standard, right? Out of two ratio are less than standard. Only one ratio is higher than standard. On the whole, see that the current liquid assets, liquid ratio is good. The remaining two ratios are not good. So when you go for bank, when you approach a bank, right? When you approach a bank, the banker is asking, for example, one company, they required some amounts for to meet his day-to-day expenses. So they approach a bank. The banker is asking, what is your current ratio? What is your liquid ratio? What is absolute liquid ratio? So these ratios are enough to know this company's working capital position. వాళ్ళకి అప్పు ఇవ్వాలా లేదా అనేది ఈ రేషియో చూసి వెళ్ళిపోతుంది బ్యాంక్. ఓకే, సో దీస్ రేషియోస్ ఆర్ వెరీ మోస్ట్ ఇంపార్టెంట్ టు నో దిస్ కంపెనీ షార్ట్ టర్మ్ సాల్వెన్సీ పొజిషన్. ఓకే, so in examination point of view also we can expect in a short term what we call short answer for this current ratio, liquid ratio and absolute liquid ratio. Now we'll move to third one is activity ratios. So activity ratios nothing but the turnover ratios. Okay, so it measures the efficiency from the company generating revenue for converting its production into cash. Production into cash or sales. So means how the asset, how this inventory has converted into production or into sales. So generally there are so many active ratios are there or convert ratios, but we'll discuss these four: inventory turnover ratio, receivable turnover ratio, average collection period ratio, and average turnover payment ratio, average payment period ratio. And finally, we also calculate working capital turnover ratios. So these ratios are also very useful for knowing the movement of assets in the movement of assets. The first one is inventory turnover ratio. Inventory turnover ratio. So this ratio indicates is a tool to evaluate the liquidity of a inventory. So how many days this inventory convert as a final product? Final product. See, this inventory turnover ratio is computed by dividing the cost of goods sold. Cost of goods sold by inventory. See the formula: cost of goods sold by average inventory at cost. So average inventory nothing but the opening inventory plus closing inventory by 2. Opening inventory plus closing inventory by 2. It is called as average inventory at cost. Okay. If it is a 2 years data is there, we'll consider it. If it is 1 year, you can take 1 year data only by dividing. So inventory turnover ratio is, turnover ratio is vary from significant among various industries. So high movements, a high ratio of indicates fast moving inventory into a low ratio. So it depends upon the various industries. We can't generalize all these, right? Second one is receivable turnover ratio, or nothing but is also called as debtors turnover ratio. So it is computed by dividing the net credit sales. We'll consider only net credit sales, not the cash sales. Okay, I think you know the difference between total sales, okay, minus sales returns is called as net sales. Okay, net sales. Okay, total sales minus sales returns are called as a net sales. So net sales minus cash sales, we'll know this net credit sales. So when you are calculating these receivable turnover ratio, we will consider only credit sales, not for cash sales. Okay, not for this cash sales. And the average receivables, same the average receivables are opening receivables plus closing receivables by 2. We get this average. So two components of a formula is called as the net credit sales, average net credit receivables. Okay. Now third one is average collection period. So how an average collection period, how many days the customers are paying the amounts? Average collection period. So if you sell a product today, the customer trade basis when they are paying the amounts, are they paying lesser amount is always preferable. The collections are always early, right? The payments are made always delay is advantage. So here when you calculating this receivables turnover ratio, now we go for average collection period. number of working days divided by debtors turnover ratio. So number of working days, if it is 365 days, or sometimes the exam is also giving considered as 360, you can take a 360 and debtors turnover ratio. You know that how many days the short collection period means the prompt collection and better management of receivables. So longer collection period may be negatively affected for short-term debt payable ability to the business as a business. So always we prefer this early collections. Next is accounts payable turnover ratio. Means we need to pay our creditors, right? So when you are paying, so like we will sell our product on credit basis. Sometimes the company also buy its raw material on credit basis from different kind of vendors or creditors. So this ratio indicates, right? This ratio is computed divided by total credit purchases by average credit payables. Credit purchases. See credit purchases, net credit purchases divided by average accounts payable. Average nothing but the opening plus closing by 2. Right? Average paying by 2. Average payment period. So how many days you are going to pay? So accounts payable is equal to daily average if we consider, or else we can use the formula. There are 3 formulas out there. As per the data available, as per the examiner asking, you can use these formulas, whichever is suitable. The last one is working capital turnover ratios. Okay, working capital turnover ratios. So is the formula working capital, you know this working capital. So working capital nothing but the very simple current assets by current liabilities. So there are so many concepts are there, broad approach and narrow approach. In broader approach, working capital nothing but the total current assets. So narrow approach is called as current assets minus current liabilities. So when you're calculating this working capital turnover ratio, we will consider the cost of goods sold by net working capital. Okay, net working capital. So net working capital means what? CA minus CL. CA minus CL. What is CA? CA? What is CA?
Current liabilities.
Current assets minus
current liabilities.
Current liabilities is called net working capital. So how to calculate the cost of goods sold? What is the formula to calculate the cost of goods sold? Already I explained this morning to calculating these two. Right? What is the formula for this cost of goods sold? Very simple. Net sales minus gross profits. You get this one. Okay. Net sales minus gross profits also called as cost of goods sold. Right. So we'll go for one problem. So this is the market security margin. And the last one is solvency ratios. Solvency ratio nothing but solvency means the paying capacity. The paying capacity. Long-term solvency ratios. It measures the ability of a business to survive for long period of time. Is a company survive for long term or not? So these ratios are very much important to shareholders, stockholders, that was shareholders on creditors. So these ratios are very used for analyzing the capital structure of the company. What is the capital structure? Capital structure of the company. My today's class is over, and tomorrow we'll continue. Hello. I lost my internet connection, so tomorrow I will continue my session.